I've lived through 14 major market crashes. I bought my first stock in 1942, right in the middle of World War II. And I've seen the market drop by over 50% on at least 6 different occasions. I've watched trillions of dollars in wealth evaporate seemingly overnight. And I've learned something that most investors never figure out. Market crashes don't just happen. They're not random events that come out of nowhere. There are always warning signs, always. Patterns that repeat themselves throughout history with remarkable consistency. And if you know what to look for, you never have to be surprised by a crash again. Today, I'm going to share with you the 4 patterns that always appear before a major market downturn. And I'm going to show you exactly what's happening in today's market that should concern every intelligent investor. Let me start with a story that changed how I think about market crashes forever. In 1969, I closed my investment partnership. I returned all the money to my investors. At the time, people thought I was crazy. The market was hitting new highs. Everyone was making money. My investors were upset that I was stepping away right when things looked so good. But I could see something they couldn't. The market was displaying every warning sign I'd learned to recognize. Speculation was rampant. Valuations were divorced from reality. And I knew what came next. Sure enough, from 1969 to 1974, the market fell by nearly 50%. Companies that had been trading at absurd valuations lost 80 or 90% of their value. Investors who thought they were geniuses because they'd made money in a rising market were wiped out. Meanwhile, I sat on cash and waited. And when the crash came, when everyone else was panicking and selling, I was able to buy wonderful businesses at bargain prices. That period of patience set up Berkshire Hathaway for decades of success. The lesson I learned wasn't just about that specific crash. It was about pattern recognition. Market crashes follow predictable patterns. They always have. From the Dutch tulip mania in the 1600s to the Great Depression to the dot-com bubble to the 2008 financial crisis, the same 4 patterns appear every single time. And they're appearing again today. Now, before I go deeper, I want to be clear about something. I'm not a market timer. I don't try to predict exactly when crashes will happen. That's a fool's game. And what I do is recognize when conditions are becoming dangerous, when the odds of a major downturn are increasing, and when it makes sense to be more cautious. That's very different from saying the market will crash next week or next month. But it does mean understanding that certain conditions always precede crashes, and when those conditions are present, intelligent investors adjust accordingly. The first pattern that always appears before a market crash is what I call rampant speculation and investor overconfidence. This is when people stop buying investments because they're good values and start buying them simply because they expect the price to go up. The focus shifts from intrinsic value to momentum, from cash flows to price appreciation, from investing to gambling. I first saw this pattern clearly in the late 1960s and early 1970s with what we call the Nifty 50 stocks. These were 50 large cap stocks that everyone believed you could buy and hold forever. Companies like Polaroid, Xerox, Kodak. The idea was that these companies were so dominant, so obviously superior, that it didn't matter what price you paid, they would always go up. Polaroid was trading at 90 times earnings. Xerox was at 70 times earnings. These weren't small speculative companies. These were mature businesses trading at valuations that could only be justified if they grew at rates that were essentially impossible to maintain. But people bought them anyway because everyone else was buying them. The stock prices kept going up, which reinforced the belief that you couldn't lose money on the Nifty 50. I watched this unfold with a sense of dread because I'd studied the history of market crashes. I knew this pattern. It's the same pattern that drove the Dutch tulip mania in the 1600s. Back then, tulip bulbs were selling for more than houses. Not because tulips had suddenly become more useful or more beautiful, but because everyone believed they could sell them to someone else for an even higher price tomorrow. The psychology is always the same. People see prices going up, they start buying, the prices go up more. More people buy. Eventually, you reach a point where everyone who's going to buy has already bought. There are no new buyers. And the whole thing collapses. It happened with tulips. It happened with the Nifty 50. It happened with dot-com stocks in 1999. And it's happening again today with certain sectors of the market. When I see people buying stocks without any consideration of valuation, when I see them justifying absurd prices with phrases like, it's different this time, or traditional metrics don't apply, I know we're in dangerous territory.
This is especially true when speculation spreads beyond professional investors to the general public.
When your barber, your taxi driver is giving you stock tips, when everyone you meet is talking about how much money they're making in the market, that's a warning sign. In the late 1920s, there was a famous story about Joseph Kennedy, John F. Kennedy's father. He was getting his shoes shined, and the shoe shine boy started giving him stock tips. Kennedy supposedly went back to his office and sold all his stocks. And he recognized that when speculation had spread that far, when even people with no knowledge of business or investing were treating the stock market like a casino, the end was near. And he was right. The crash in 1929 came shortly after. I saw the same thing in 1999. Cab drivers were telling me about their day trading profits. College students were dropping out to day trade. New brokerage accounts were opening at record rates. People were buying anything with .com in the name, regardless of whether the company had any path to profitability. Stock prices were doubling and tripling in days based on nothing but speculation. And I knew it couldn't last. And when I speak at events during that period and said that I didn't own any technology stocks, people looked at me like I was senile. And here was this old man who didn't understand the new economy, who didn't grasp that the internet changed everything, who was using outdated metrics to value companies. But I wasn't confused. I simply recognized the pattern of speculation and overconfidence, and I knew how it would end. The second pattern that always appears before major crashes is what I call regulatory shortcomings or policy failures. This is when the people in charge, whether it's regulators or central banks or government officials, either fail to act when they should or act in ways that make the problem worse. And
sometimes this means acting too late. By the time regulators step in, the bubble has already inflated to dangerous levels. Any attempt to deflate it gradually instead causes it to burst. We saw this in the panic of 1907, when Theodore Roosevelt's trust-busting campaign, while well-intentioned, came so suddenly and forcefully that it triggered a financial crisis.
Other times means not acting at all. In the 1920s, regulators essentially let the market run wild. There were almost no rules around margin lending, around investment trusts, around disclosure requirements. The attitude was laissez-faire. Let the market police itself. And what happened? A bubble of historic proportions that ended in the Great Depression. The challenge for regulators is always finding the right balance. Regulate too much too soon, and you stifle innovation and growth.
Regulate too little too late, and you allow dangerous excesses to build up. It's a difficult balance to strike, which is why regulatory failures appear before almost every major crash.
I watched this play out in the lead up to the 2008 financial crisis. For years, I'd been warning about derivatives. I called them financial weapons of mass destruction in my 2002 annual letter to shareholders. I could see that these instruments were becoming more and more complex, that the risks were being hidden and obscured, that the financial system was building up leverage on top of leverage, but regulators didn't act. Alan Greenspan, the Federal Reserve Chairman at the time, believed that markets were self-correcting. He believed that rational self-interest would prevent financial institutions from taking on too much risk. This was a fundamental misunderstanding of human nature and market psychology. Financial executives are rewarded for short-term profits. If taking big risks generates big profits for a few years, they get rich. If those risks blow up later, well, they've already made their money. The incentives were all wrong.
We also saw regulatory failures in the form of misguided policy. The government actively encouraged home ownership, even for people who couldn't afford homes.
Fannie Mae and Freddie Mac, the government-sponsored enterprises, were providing implicit guarantees for mortgages, which encouraged lenders to make riskier and riskier loans.
The Community Reinvestment Act pressured banks to lend in low-income areas without adequate consideration of creditworthiness. All of these policies, each individually perhaps well-meaning, combined to create a housing bubble of massive proportions.
And the regulators who should have been pumping the brakes were instead stepping on the gas. Interest rates were kept too low for too long. Lending standards were loosened. Leverage was allowed to build up throughout the financial system. When I see regulatory failures today, I pay attention. When I see the Federal Reserve keeping interest rates at zero for years on end, flooding the system with money, I worry about what bubbles they might be creating. When I see politicians pressuring regulators not to act against certain industries or companies because they don't want to disrupt the economy or the stock market, I worry about what problems are being allowed to fester.
The third pattern that always precedes major crashes is new innovations that people don't fully understand.
Every market crash features some new financial product, some new structure, some new way of doing things that seems brilliant at the time, but turns out to have hidden risks that no one appreciated. In the 1920s, it was leveraged investment trusts. These were essentially mutual funds that borrowed money to amplify their returns. The idea was simple. If you had $1 million and you invested it and made 10%, you'd make $100,000. But if you borrowed another million, invested $2 million, and made 10%, you'd make $200,000. Subtract the interest on the loan and you still came out ahead. This worked great when markets went up, but it was catastrophic when markets went down. The leverage that amplified gains on the way up amplified losses on the way down. And because these investment trusts often invested in other investment trusts, you had leverage on top of leverage. When the crash came in 1929, these structures collapsed spectacularly, wiping out countless investors. In the late 1980s, the new innovation was portfolio insurance. This was a sophisticated trading strategy that was supposed to protect institutional investors from market declines. And the idea was that computers would
automatically sell stocks as prices fell, limiting your losses. It sounded brilliant, a seatbelt for your portfolio.
But nobody considered what would happen if everyone was using portfolio insurance at the same time. When the market started falling in October of 1987, all these computer programs started selling automatically. This pushed prices down further, which triggered more selling, which pushed prices down even more. It became a self-reinforcing spiral. On October 19, 1987, the market fell 22% in a single day. It's still the largest one-day percentage decline in stock market history. The 2008 crisis featured multiple innovations that people didn't understand: mortgage-backed securities, collateralized debt obligations, credit default swaps. These instruments were so complex that even the people creating and selling them didn't fully grasp the risks. I certainly didn't. I avoid things I don't understand, and which is why Berkshire had minimal exposure to these derivatives. But most of Wall Street jumped in with both feet. The fundamental problem with all these innovations is that they look brilliant in good times. They seem to generate profits with little risk. Everyone piles in. But they haven't been tested in truly stressful conditions. Nobody knows how they'll perform when things go wrong. And when you combine new, poorly understood innovations with speculation and regulatory failures, you have a recipe for disaster. Today, I see new innovations that concern me. Algorithmic trading and high-frequency trading have fundamentally changed how markets operate. Most trading volume now comes from computers executing strategies that happen in milliseconds. I don't fully understand these systems. I don't know how they'll behave in a crisis. Will they amplify market moves? Will they freeze up? Nobody really knows because we haven't had a true stress test yet. So cryptocurrency is another innovation that many people don't understand. I've been very public about my skepticism. I don't see the intrinsic value. I don't understand why a purely digital token that produces nothing should be worth anything, let alone the trillions of dollars in market value these things have achieved. Maybe I'm wrong. Maybe I'm just too old to understand it. But my rule has always been that if I don't understand something, I don't invest in it. And I don't understand crypto.
The fourth and final pattern that always appears before major crashes is excessive debt. This is perhaps the most important and most dangerous pattern. Debt amplifies everything. It magnifies gains when things go well,
but it also magnifies losses when things go wrong. And when debt levels get too high across the economy, a small problem can become a catastrophe. I learned about the dangers of debt early in my career. When I was running my investment partnership in the 1950s and 1960s, I never used leverage. I never borrowed money to invest. This meant that my returns in good years were lower than they could have been. But it also meant that I never risked catastrophic losses. I could always survive to invest another day. Debt is seductive because it seems to make you richer without any cost. If I can borrow at 5% and invest at 10%, I'm making free money, right? The problem is that this only works if everything goes according to plan. If the investment drops in value, if interest rates rise, if the lender demands repayment at an inconvenient time, suddenly that debt becomes a noose around your neck. In the lead up to the Great Depression, debt levels were extraordinarily high. People were buying stocks on margin, borrowing 90% of the purchase price. Investment trusts were leveraged. Banks were lending money they didn't have. When stock prices started falling, margin calls went out. People had to sell stocks to repay their loans. This pushed prices down further, triggering more margin calls, more selling, more decline. It was a death spiral. The same pattern appeared in 2008. This time, the debt was concentrated in housing. People were buying homes they couldn't afford with mortgages they didn't understand. Adjustable rate mortgages, interest-only mortgages, no doc mortgages where you didn't even have to prove you had income. The financial system was built on the assumption that housing prices would always go up. When housing prices started falling, the whole structure collapsed. People couldn't refinance, they couldn't sell. They defaulted on their mortgages. The securities backed by those mortgages became worthless. The banks that held those securities faced catastrophic losses. And because banks are themselves highly leveraged institutions, small losses to their equity can wipe them out entirely. Bear Stearns failed. Lehman Brothers failed. Merrill Lynch had to be rescued. Fannie Mae and Freddie Mac had to be taken over by the government. AIG, one of the world's largest insurance companies, had to be bailed out to the tune of $185 billion, all because of excessive debt. The debt problem today concerns me greatly. U.S. government debt is now over $34 trillion, well over 100% of GDP. Corporate debt is at record highs.
Consumer debt is at record highs. We've borrowed against the future to maintain current consumption, and at some point, that bill comes due. When interest rates were at zero, this debt seemed manageable.
But now that rates have risen to 5% or more, the interest payments are becoming crushing, and the U.S. government is spending over $1 trillion per year just on interest on the debt. That's more than we spend on defense, more than we spend on most other government programs. And it's growing rapidly as old debt issued at low rates is refinanced at higher rates. This is not sustainable. Something has to give. Either we have to cut spending dramatically, which is politically almost impossible, or we have to raise taxes dramatically, which would slow economic growth. Or the Federal Reserve has to print money to buy government bonds, which would cause inflation. None of these options are good.
At the corporate level, I see companies that loaded up on cheap debt during the era of zero interest rates now struggling to service that debt as rates have risen.
Companies that looked healthy at 2% interest rates are losing money at 7% rates. Some of them will default, some will go bankrupt. And when companies fail, it affects their employees, their suppliers, their customers. It ripples through the economy. Now, let me talk about how these four patterns interact and reinforce each other. Because the really dangerous situation is when you have all four patterns present simultaneously. That's when you get crashes that are truly catastrophic. Think about the 1920s. You had rampant speculation with people buying stocks on borrowed money purely to flip them for quick profits. You had regulatory failures with essentially no oversight of the financial system. You had new innovations like leveraged investment trusts that nobody fully understood, and you had excessive debt throughout the economy. When the crash came, all four patterns combined to create the Great Depression. The same thing happened in 2008. Speculation in housing markets with people buying multiple properties as investments. Regulatory failures with no one overseeing the mortgage market or the derivatives market. New innovations like CDOs and credit default swaps that even sophisticated investors didn't understand. And enormous amounts of debt at every level of the economy. The result was the worst financial crisis since the Depression. What worries me is when I see multiple patterns present at the same time. When speculation is combined with regulatory failures, or when new innovations are fueled by excessive debt, the risk of a severe crash increases dramatically. And right now, I'm seeing all four patterns in various parts of the market. Let me be specific about what I'm observing today. Starting with speculation and overconfidence, I see it in certain sectors.
Technology stocks, particularly in artificial intelligence, are trading at valuations that assume decades of perfect execution.
Companies with no profits, sometimes with no revenue, are valued at billions of dollars based purely on the promise of what AI might accomplish. I see speculation in private markets.
Venture capitalists are funding startups at valuations that would have been laughable a decade ago. Billions of dollars flowing to companies that are burning cash and have no clear path to profitability.
The attitude seems to be that as long as the story sounds good, as long as there's a plausible narrative about disruption and innovation, valuation doesn't matter. I see it in
Meme stocks and cryptocurrency, where prices seem completely disconnected from any traditional notion of value.
people are buying these things not because they've done fundamental analysis, not because they understand the businesses, but because prices are going up and they want to be part of it. And on regulatory failures, I'm concerned about the Federal Reserve's policies. They kept interest rates at zero for far too long after the 2008 crisis. This encouraged all sorts of risk-taking behavior. It pushed investors into riskier and riskier assets searching for yield. It allowed zombie companies, businesses that don't generate enough profit to service their debt, to stay alive.
And now that they've raised rates quickly, we're going to discover how many problems were hidden by those zero interest rates. I'm also concerned about the lack of oversight in certain new markets.
Cryptocurrency has been essentially unregulated. Private markets have much less disclosure and transparency than public markets. Special purpose acquisition companies, or SPACs, have been used to take companies public with far less scrutiny than traditional IPOs. These regulatory gaps create opportunities for abuse and excess. On new innovations, algorithmic trading and AI-driven investment strategies concern me. These systems can move enormous amounts of money based on correlations and patterns that they detect in the data, but they haven't been tested in truly adverse conditions. What happens when multiple AI systems all decide to sell at the same time? What happens when these algorithms encounter a situation they weren't trained on? I don't know, and neither does anyone else. And on debt, as I mentioned, debt levels are extraordinarily high across the economy. Government debt, corporate debt, consumer debt. We've borrowed against future growth to maintain current consumption. And now that interest rates have risen from 0 to 5%, the cost of servicing that debt has exploded. This is going to cause problems. The only question is how severe those problems will be. Now, you might be thinking, okay, Warren, you've painted a pretty grim picture. You've shown me these patterns. You've told me they're appearing again today. So what should I do? Should I sell everything and go to cash? Should I buy gold? Should I try to time the market and get out before the crash? The answer is no to all of those. Let me tell you what I actually do and what I think intelligent investors should do. First, understand that I don't try to time the market. I don't try to predict when crashes will happen. I've been around long enough to know that's impossible. So the market can stay irrational longer than you can stay solvent. Just because conditions are ripe for a crash doesn't mean it will happen tomorrow or next month or even next year. What I do instead is focus on value. I always ask the question, what is this business actually worth based on its cash flows, its competitive position, its management quality? When I find businesses trading well below their intrinsic value, I buy them. When I can't find anything trading at a reasonable discount to intrinsic value, I hold cash and wait. Right now, I'm holding a lot of cash, over $325 billion at Berkshire Hathaway. Some people criticize me for this. They say I'm missing out on market gains. They say I should be investing that cash. But I'm patient. I'd rather wait for opportunities than overpay for assets just because I have money to deploy. Second, I focus on quality businesses.
When times get tough, when the economy slows down, when credit markets freeze up, the companies that survive and thrive are the ones with strong balance sheets, consistent profitability,
and durable competitive advantages. I want businesses that can withstand a recession, a financial crisis, or any other challenge the economy might throw at them. I don't invest in highly leveraged
Companies, no matter how attractive the story might be, leverage kills. When things go wrong, the companies with a lot of debt are the first to fail.
I want businesses with strong balance sheets, businesses that can not only survive tough times, but actually thrive by taking market share from weaker competitors who fail. Third, I maintain discipline on valuation.
No matter how good a business is, there's a price at which it becomes a bad investment. And I've seen people pay absurd prices for wonderful companies and lose money because they overpaid. And price is what you pay, value is what you get. If you pay too much, even for the best business in the world, you'll have poor returns.
This discipline is especially important when markets are frothy, when speculation is rampant, when everyone else is abandoning valuation metrics.
That's when it's most tempting
to just go along with the crowd, to accept that traditional metrics don't apply, to justify high prices with stories about future
growth. But that's also when discipline is most important. Fourth, I think long term. I'm not worried about what my stocks will do next week or next month or even next year. I'm thinking about where these businesses will be in 10 years, in 20 years. If I buy a wonderful business at a fair price and the market crashes, so what? The business is still wonderful.
It's still generating cash flows. Eventually, the market will recognize its value. This long-term perspective is what allows me to sleep well at night, even when I see warning signs of a crash.
Because I know that if I own good businesses at reasonable prices, short-term market fluctuations don't matter. What matters is the long-term earning power of the businesses I own. Let me give you an example. During the 2008 financial crisis, Berkshire's stock price fell just like everything else. We dropped from around $140,000 per share to $80,000 per share. That's a decline of over 40%. But I wasn't worried. Why? Because the businesses we own, companies like See's Candies and Geico and Burlington Northern Railroad, they were still operating, still serving customers, still generating profits. Yes, their earnings declined during the recession, but they were still fundamentally sound businesses. And when the crisis passed, they were stronger than ever because many of their competitors had failed. That's the advantage of owning quality businesses with strong balance sheets. They don't just survive tough times, they emerge stronger. Fifth, I keep some powder dry. I always maintain cash reserves so that when opportunities appear, I can act. The best time to invest is when everyone else is panicking, when asset prices have fallen dramatically, when quality businesses are available at bargain prices. But you can only take advantage of those opportunities if you have cash available to deploy. This is why I don't worry too much about holding cash during bull markets. And yes, cash has an opportunity cost. Yes, I could be investing that cash and earning returns. But the cash also gives me optionality. When the crash comes, and it always does eventually, I'll have the resources to buy aggressively while everyone else is selling. In March of 2009, at the depths of the financial crisis, I was able to make several major investments. I invested $5 billion in Goldman Sachs, $3 billion in General Electric. These weren't charitable donations. These were calculated investments in strong companies that were facing temporary liquidity challenges, and they turned out to be enormously profitable for Berkshire. But I could only make those investments because I had cash available at exactly the right moment. Sixth, I don't get emotional. Fear and greed drive most investors. They get greedy when markets are rising and buy at high prices. They get fearful when markets are falling and sell at low prices. This is exactly backwards. You should be buying when others are fearful and selling when others are greedy. This is easier said than done. It requires emotional discipline to buy when everyone around you is panicking, when the news is terrible, when it feels like the world is ending. It requires emotional discipline to sell or hold cash when everyone around you is making money and you feel like you're missing out. But this emotional discipline is what separates successful investors from unsuccessful ones. I've developed this discipline over decades. I've seen enough market cycles that I no longer react emotionally to volatility. When the market crashes, I see opportunity, not danger. When the market is euphoric, I see risk, not opportunity.
This perspective has served me well throughout my career. Now let me address a common question. What about diversification? Shouldn't you spread your money around to protect yourself from crashes?
Yes and no. Diversification is important if you don't know what you're doing.
If you're picking stocks randomly or investing based on tips you heard at a cocktail party, you should definitely diversify broadly because you're going to make mistakes.
But if you actually understand the businesses you're investing in, if you've done thorough analysis, if you're buying quality companies at reasonable prices, you don't need as much diversification. Charlie Munger and I have always believed that if you have 3 great ideas, that's diversification enough. We'd rather have concentrated positions in businesses we understand deeply than own hundreds of businesses we know nothing about.
That said, for most individual investors, I would recommend broad diversification through index funds. Most people don't have the time, skill, or inclination to analyze individual businesses.
For them, buying a low-cost S&P 500 index fund and holding it forever is probably the best strategy. It's simple, it's low cost, and it gives you exposure to the economy's growth over time. Even with index funds, though, the principles I've discussed still apply. Don't try to time the market. Don't sell in a panic when prices fall.
Don't get greedy and pour all your money in when markets are at all-time highs. Just invest regularly, maintain discipline, and think long-term. Let me also address what not to do.
Don't try to trade your way around crashes. Don't think you can get out at the top and get back in at the bottom. Market timing doesn't work. I've never seen anyone do it successfully over long periods of time. Yes, some people get lucky once or twice, but consistently timing the market is impossible.
Don't try to hedge using derivatives or complex strategies. These often cost more than they're worth, and they add unnecessary complexity. If you own quality businesses at reasonable prices, you don't need hedges. The business fundamentals will protect you over time. Don't abandon stocks entirely and move to cash or bonds.
Over the long term, stocks have delivered far better returns than any other asset class. Yes, they're more volatile. Yes, they go through painful crashes. But if you can tolerate that volatility, if you can stick with it through the tough times, stocks will make you wealthy over decades. And please don't try to protect yourself by buying things like gold or cryptocurrency. These are not productive assets. They don't generate cash flows. Their value depends entirely on someone else being willing to pay more for them in the future. That's speculation, not investing. Over the very long term, businesses create value. Speculative assets don't. Now, let me share what I'm actually doing today with Berkshire's portfolio. As I mentioned, we're holding a record amount of cash. This tells you that I'm not finding many opportunities that meet my standards for value. Most stocks are expensive relative to their intrinsic value. So we're being patient. We're also reducing some positions. We've been selling shares of Apple, one of our largest holdings, not because we think Apple is a bad business. It's a wonderful company. But at current valuations, we thought it made sense to take some profits.
We bought Apple at much lower prices years ago. Selling some shares now at these higher prices is just prudent portfolio management. We continue to own businesses that we believe can withstand any economic environment.
Our insurance companies like Geico and General Re, our railroad, Burlington Northern, our energy business, our manufacturing operations.
These are all businesses that provide essential services, that have strong competitive positions, that generate consistent cash flows, even in recessions. We're also looking for opportunities.
When the market does crash, when quality businesses become available at bargain prices, we'll be ready to invest aggressively. That's why we're holding so much cash. Not because we're bearish on America or on the economy long term, but because we're being selective. We're waiting for prices that offer good long-term returns. This approach has worked for me for over 70 years. It's boring. It's not exciting. You won't get rich quick. But you also won't lose your shirt when the inevitable crashes come. And over time, if you stick with it, you'll build substantial wealth. The 4 patterns I've described, speculation and overconfidence, regulatory failures, poorly understood innovations, and excessive debt. These patterns always appear before major crashes. They're appearing again today in various forms. And does this mean a crash is imminent? I don't know. Nobody does. The market can remain irrational for a long time. These conditions can persist for years before anything breaks. But I do know that when these patterns are present, the risk of a severe downturn is elevated, and I adjust my behavior accordingly. I become more cautious. I hold more cash. I'm more selective about new investments. I focus even more on quality and value. History doesn't repeat, but it rhymes. The specific details of each crash are different. The 1920s crash was about investment trusts and margin lending. The 1980s crash was about portfolio insurance. The 2000s crash was about housing and derivatives. The next crash will be about something else. But the underlying patterns, the psychology, the dynamics, those are always the same. Speculation builds. Regulations fail to keep up. New innovations create hidden risks. Debt amplifies everything. And eventually, something triggers the collapse. A piece of bad news. A policy mistake. A random event that pops the bubble. When that happens, the people who've been careful, who've maintained discipline, who've focused on value and quality, they'll be fine. They might see their portfolios decline temporarily, but they'll survive, they'll recover, and they'll have cash available to buy when assets are cheap. But the people who get hurt are the ones who abandon these
Principles during the good times, who chase hot stocks at inflated prices, who use leverage to amplify their bets, who invest in things they don't understand because everyone else is doing it.
Those are the people who lose everything when crashes happen. My advice is simple. Study these patterns, watch for them in the markets. When you see them building, adjust your strategy, become more cautious, hold more cash, focus on quality, maintain discipline on valuation, think long-term.
Don't try to time the market, but do recognize when conditions are becoming dangerous and act accordingly. And most importantly, never forget that the goal of investing is not to avoid crashes.
Crashes are inevitable. They're part of the system. The goal is to position yourself so that crashes don't destroy you, so that when everyone else is panicking, you can stay calm, and so that when opportunities appear, you're ready to act. That's what I've been doing for 7 decades. It's worked pretty well so far. And I believe these principles will continue to work for as long as markets exist.